Thanks everyone so much for joining us this morning for our second panel session of ASC Connect 2021. I'm Denise Weeres with the Alberta Securities Commission, and I am very pleased to be able to moderate this session. Fostering diversification and capital formation through private and public financing. We've got four great panelists here this morning, and I am excited to introduce you to each of them. I think when we look at the statistics like market intelligence reports from the Canadian exchanges or the stats from the Canadian Venture Capital Association, it's evident that we are seeing changes in the capital market. There's a lot of financing activity, M&A activity, and as Minister Taves mentioned this morning, a record venture capital investment. So things are certainly starting to trend in the right direction. But we know there are a lot of changes affecting our capital markets, and we know there's still room for growth. We want to take some time this morning, talk about some of those changes, and hoping that entrepreneurs and investors will be able to take away from this an appreciation of the financing and investing alternatives to them. So I want to introduce you now to each of the panelists. First, Judy Fairburn. Judy's an investor and a business leader. She's the co-CEO and fund managing partner of the 51, a venture fund focused on putting women-led capital to work. She's also a director of EVOC Innovations, a clean tech and digital VC fund. She has served as both a director and as an executive of both publicly traded and private companies, bridging both the energy industry and the technology sector. She's a director on the Business Council of Alberta, a fellow of Creative Destruction Labs Rockies, and she was formerly the chair of both Alberta Innovates and Canada's Oil Sands Innovation Alliance. Next, John Horsman. John's both a senior executive vice president with ATB Financial, Alberta's own financial institution, and he serves as CEO of ATB Capital Markets, which was formerly Alta Corp Capital. That's ATB's investment dealer arm. He's responsible for strategy, direction, and leadership. So his responsibilities really span both providing banking services to Alberta businesses and the investment banking or capital market solutions. Patrick Lohr. Patrick's a successful technology entrepreneur turned investor. He's managing partner at Panache Ventures, a seed stage venture capital firm that's invested in over 95 startups. He's an active angel investor and a limited partner investor in a number of other venture capital firms such as Inovia Capital. He's a mentor and an advisor through various organizations like 500 Startups Canada, several incubators, and both the A100 here in Alberta and the C100, both of which are organizations supporting tech entrepreneurs with advice and capital. And last, Irfan Raji. Irfan's the founder and CEO of Mobsquad. They provide innovative solutions to bring international software engineers to work in North America. Irfan is also the managing partner with Relay Ventures, an early stage venture capital firm. And he's an adjunct professor at the Sauder School of Business. He has experience as well as a director with both public and private businesses, from startup to established companies in a wide variety of sectors: energy, technology, banking, media, and also serves on the boards of various charitable organizations. Thanks to each of you for agreeing to participate today. Our panelists have indicated they are keen to make this an interactive session and take questions from our audience. So I encourage you to use the Q&A function at the bottom, not the chat function. The producers are hoping to use that to keep me in line and tell me when I'm messing up. So please enter your questions in the Q&A. We'll definitely leave time at the end to take questions, but hoping to fit some of them in as we go, if I can monitor it. So maybe before we get started, to orient the audience and sort of table set the discussion, I'm going to ask each of you if you could just take a couple of minutes to speak briefly about the role you're playing in Alberta as an investor. And maybe if you could share with the audience a bit about if there's particular sectors that you're focused on or particular sizes of financings, stages of development of companies that you're working with. Maybe, John, I'm going to start with you. You got a bit of a different perspective. If you can tell us from the investment dealer public markets perspective, what's the space that you're in?
Thank you, Denise, and thank the Alberta Securities Commission for hosting this panel. It's a great opportunity. I understand that we've got actually over 500 participants on the line listening, so this is kind of impactful. So as per Denise's lead in, we in ATB have a capital markets arm. We are kind of deeply embedded, I guess, into the core industries of Alberta and looking to kind of raise capital, whether it's coming off our own balance sheet or bringing institutional or other capital sources to the table. In terms of where we focus, it's on those core industries of energy, and real estate and agriculture, albeit the capital markets tend to kind of jump in front of where some of our traditional industries are. And so where we focus in capital markets, to be honest, in terms of that franchise, is on growth and innovation, technology, which I think we're going to talk a lot about here today. Life sciences, which is a bit of a euphemism for cannabis, which has been a really interesting sector for Canada as we kind of opened up our capital markets, first in the world, and invited a very, very large wave of capital. And we're working through kind of various life stages of that industry cycle. And then we do also provide investment banking and capital services to the traditional industries of engineering, construction companies, logistics, and some of those traditional industries.
Great, thanks. Judy, maybe we'll go to you next.
Good morning. Great panel. Thank you to ASC. So just a quick overview I can of the 51. We are a financial feminist platform and venture fund. We're investors, entrepreneurs, and those that aspire. That aspire piece is really important to us. Come together for democratized access to women-led capital, primarily in women-led ventures. And so it's an and, building mutual wealth and social environmental impact, and co-led by Shelley Kuipers, who co-founded it with Alice Reimer and myself, and an amazing team. And I think the key piece for us is capital plus community. So we've got a community globally now over 15,500, and our Fund 1 has activated 9 million of women-led capital. We've got 100 really engaged LPs, all kinds of backgrounds, amazing, and 90% of them who are women, which is really quite unheard of, I think, in Canada. And 30% of whom hadn't been previously invested in venture, and amazing male champions who've also invested and come on this journey with us. So really we're focused on both unlocking a new investor group, driven out of us founding this in Alberta, as well as focusing on the amazing founders across Canada, and particularly here in Alberta. I would just want to give a shout out, to the recent AEC study. Alberta continues to lead on women tech founders at almost 30%. That compares incredibly well versus the global average of 20% through the Crunchbase 2020 report. And then for that same AAC study, tech firms that managed to get themselves profitable within 2 years, 35% of those have a female co-founder. And then, if we look at the stats from Start Alberta, again, thanks AAC for that, data shows that 88% of women-founded companies have participated in Series B rounds. So to us, this says is an opportunity in this province. It's a new kind of diversification, focusing on women-led founders. We've invested in 14 actually since in our $9 million activated fund since we started it, including several Alberta companies. Quick shout out: Virtual Gurus, True Angle, Cyantra, Reap, others before that in clean tech and the like. And if I can just take one more moment in terms of what is our investment thesis, largely seed stage. And it's driven by the following significant trends and facts. Women are forecast to control 2/3 of Canada's wealth by 2030. So that points to an economic imperative and opportunity that women are going to be equal in all matters financial. That's where financial feminism comes from. And then secondly, women make up 85% of consumer decisions. So a unique perspective on what customers need as it drives you into direct-to-consumer e-commerce. The first trend, of course, really drives the fintech. And then third, Women and racialized populations, we care a lot about sustainability. I know we all do. Great panel this morning. One Health, in terms of the cycle there, and women make 80% of food purchase decisions. So that drives the emphasis we've done, again, seed stage in health and fintech and food and ag tech. And I think there's been some good articles lately in terms of our entry now into food and ag tech. We've expanded from our history here of women-led to also include founders from various underrepresented groups, Black, Indigenous, people of color, LGBTQ+. So again, just to, I think, sum up here, we've got a flywheel opportunity driven from this province of unlocking women-led capital with amazing male champions as well. Binary, the financial, the talent, and the networks. Again, capital plus community to drive what's possible in these underestimated founders. So thanks for the opportunity.
Great, thanks. Patrick, maybe we'll go to you next. What industries, financing size, stage of development, what are you looking at?
Yeah, very similar to what Judy just talked about, which is early stage tech. And I think that, aside from the 95 investments that we've done in Panache Ventures over the last 3.5 years, I think that our role specifically in Alberta is essentially to make sure that people don't think about these early stage startups as being something exotic that only a small group of people can play in. I know John, I sit on ATB's board. I've invested in Irfan's company. I've co-invested with Judy. I think this is just a small microcosm of what can happen when a group of people get together and work with each other to create a viable ecosystem for early stage tech entrepreneurs. And these entrepreneurs are going to create massive amounts of wealth, and not only wealth, but they're going to start disrupting the way that we work and the way that we live with new technologies. Now, the reason why I bring up the group here as an example is that this is way too small of a group. When we think about this as, you have to know tech, or you have to be in the circle to invest in venture capital. It's not true, right? And so we need to widen out this circle so that people in oil and gas, people that are traditionally investing in the public markets, need to look at this as a legitimate asset class. Not only where you can make money, but where you're actually going to change the world. And Judy's mission, I think, is absolutely incredible, and we're 100% behind that mission.
Okay, great. Irfan, same question to you.
Sure, and Denise, thank you and the ASC for putting this summit together. I think it's great that you, as the regulator, are doing this. So in addition to my role at Mobsquad, I'm a managing partner at Relay Ventures, which is a $600 million US dollar asset manager. We invest in technology, early stage technology, just like Pat and Judy, starting as really the first institutional investors, so seed rounds. But we are life cycle investors, so we'll continue through the Series A, B, and C, and continue to support companies as they grow. We do focus on a few sectors. We focus on prop tech, on fintech, and on mobility. These are areas that we historically have had good success, and we think that we can, because of our experience in those areas, bring more than just capital to bear, because we actually understand those industries can bring connections, can bring knowledge. And so those are areas that we're focused on. And I want to reiterate, what Judy and John and Pat have said in terms of their comments about the ecosystem. I think that there's lots of room for more folks and for us to continue to push the agenda as it relates both technology diversification in our province, but also as it relates to social issues like diversity and inclusion. And I guess maybe my last comment is actually to Pat. Thank you for investing in Mobsquad. You kept telling me I was super special, but now I realize I'm only one of 95. So I guess I'm not as special as you told me.
All right. I'm sure you're still special. Okay, I think that's good. And I want to circle back and ask you some more questions going forward on some of the community and things like that. But first, you sort of a general question, and you're all welcome to answer it, but I'm going to ask Judy and Irfan maybe if, given your experiences, sort of on the ground, what's your impression? Like, are entrepreneurs in Alberta finding the capital that they need? And is there a particular area where it's proving more challenging?
I think it's a great question. I think the capital is there. One of the key elements we need is more entities that are willing to lead and be the lead investor. And to be able to do that at some degree of pace so that we can effectively compete with other jurisdictions and scale our companies.
Yeah, I would concur with Judy's assessment. I think that the capital is there. It's interesting in that I don't think that you need to match a company in a region with capital from that region. I think the company in a region like Alberta should get the smartest capital it can get. And so entrepreneurs can't sit in Calgary or Edmonton and expect that, venture capitalists are going to come to them. Your goal as an entrepreneur is, you got to go to San Francisco, you got to go to Toronto, you got to go to New York, and you have to go find, the best capital for you that comes with more than just dollars. And so I think an entrepreneur anywhere can get capital. It's better if you have individuals like Judy and Pat in the ecosystem. And the reason for that isn't access to capital, it's access to mentorship. That is actually where I think we have a bit of a gap still. It's closing. But if you were an entrepreneur starting your business, in Silicon Valley, the access to mentorship there for you to help build and scale is greater. And that's why programs like CDL are really critical. In my opinion, that's been the most game-changing thing that's happened to our ecosystem because it's brought mentorship into this market. If there was one area that I still think lags, and it's not just Alberta, but I'd say this is across Canada, it's in later stage financing. We see that most of our companies need to go to the US or Europe to get, Series B, Series C, and D financings. And it's just the quantum of capital that's in Canada for those types of financings is less than I think we would like to see, but that'll grow over time. This is a bit of a chicken and egg. Like, if there's more opportunity, there's more capital will come. If there's more capital, there's more opportunity. And so we have to crack that a bit by bridging into other markets for now.
Okay. Judy, you wanted to add something?
Yeah, excellent points. And if I could just add on, and a real privilege to be involved in CDL as well. And I think CDL brings business judgment from amazing group of mentors. Really, I echo, it's been pivotal to what we're doing in this province. What I think I suggest we see there, and we see within the 51, and I want to just reiterate the point that this is the 51's mission. Shelley, myself, Alice, and the whole team, and all our investors and broader community. This is a community driving the 51. But what I think we're seeing is consistently with founders, the financial, commercial, and business acumen is an area that we coach a lot on, as well as how do you go to market? How do you get in the space to create market pull rather than push about your idea?
I think one other thing to add to that, Judy, you and I have been part of CDL, and I've learned so much out of that. And I think that there's a power dynamic in investing that I think the assumption is that the investors know everything because they have the money, and entrepreneurs don't know anything because they need the money. And in fact, often the case that's not true is that investors need education as well. And I think CDL sets up the stage perfectly for that, which is I've gone there and I've learned so much about the companies out there. I've learned more about investing. I've learned more about coaching and learning how to help entrepreneurs through this journey. So it's super important that we adjust our perspective on this, is that money does not equal intelligence.
Good. Just for our audience, CDL is the Creative Destruction Labs, Rockies, out of the University of Calgary. Can anyone just spend like 30 seconds and maybe Judy and just explain CDL a little bit for those who aren't familiar with it?
Indeed, and Pat, Irfan, please jump in as well. And John, I know ATB is really much at the table as well. CDL and it's started in Toronto. It's gone global now. CDL Rockies, representing the Prairies, led by site leader Alice Reimer again. It has been a really dynamic force for taking science, technology-based founders and helping them dramatically scale, ideally to massive potential companies. And I think what's really key about the room is you've got experienced entrepreneurs, investors, business leaders there, plus science experts and MBA students who do a lot of learn by doing and working with the founders that come together to help propel these companies. I think one of the essence of CDL that I love is the three objectives that are time bound, that put in this pressure and focus for founders. If you do these things and then come back and say 2 months, you're building that momentum. And so I think, to conclude this, it's the amazing aggregate judgment that's in the room and experience that makes CDL special.
Thanks.
Maybe just one comment, and I hope I'm not talking out of school, but it's also one of the most successful accelerators I think Alberta's ever seen. I understand that almost $1 billion of capital has been raised for the successful candidates that have graduated from CDL, which is a staggering amount of capital for Alberta.
In a lot of ways, John, I think that illustrates how important it is that we think about investing as more than just a return on investment, that there is a social aspect to it. There's a massive trust aspect to it. There needs to be trust between the investors. There needs to be trust between entrepreneurs and investors. And so I think, to me, Creative Destruction Lab is building that connective tissue to allow more Albertans to work together on things that they normally wouldn't work on if we stayed in our own lanes.
Okay, thanks. Irfan, maybe I'm going to go back to you. You mentioned mentorship. So I heard that we need more investors to be lead investors. And then one of the benefits of those investors is sort of that mentorship. Can you sort of provide a bit more details on what does mentorship look like and what benefits does that provide?
Yeah, I mean, I think Judy highlighted it in terms of, talking about Creative Destruction Lab. When you have people that have been there before, that have seen it before, they help you avoid mistakes. They help you understand what it is you need to be focused on. And so, an entrepreneur investor, like somebody like Pat, who's actually been an entrepreneur and investor, is so much more valuable than somebody that hasn't seen that before. And so, for me, what I've done with our companies at Relay, for me personally, is surrounded us with advisors that have seen other analogs in other industries or within our industry at Mobsquad, so that they can actually help us see around corners. You don't need to learn everything for the first time. And unfortunately, when you're in a nascent ecosystem in technology, there aren't that many people that have seen this before, right? And I don't think this is different than any other industry. If you think about being an entrepreneur, in many ways, it's an apprenticeship business. You have to learn by doing. So is being a doctor, so is being a dentist, so is being a carpenter. Why is it any different in this industry than others? It's just, if you want to be a doctor and you're in a market where you can't be a resident because there's no one to train you, that's a harder market. So what we need to do is import these mentors. And that's what, Mobsquad, what we've done, right? We have 10 advisors, and I think the vast majority of them are in the United States.
Anyone else want to add on to that? No? Okay. All right. I wanted to talk a bit about some of the changes that we're seeing happening in the capital markets and sort of the return of the retail investor, some of the technology changes, some of the switch to not focusing just on investing, on the bottom line, but other social and governance factors. Maybe, John, I'll start with you and just ask you to comment on, what do you see as being sort of the most significant changes happening?
I love the question, and I'm going to go down a little bit of memory lane or a little bit of history here, just to explain a little bit to where we are today, and just also to maybe just articulate a little bit about how significant it is. I feel we are in the Napster moment of of capital investment, in terms of what the music industry was. And so, if you step back, I mean, the capital markets really got a big injection when we moved from defined benefit plans to defined contribution plans. And what we did when that happened is we moved the aggregation of capital outside of kind of companies and moved them into, effectively into investor hands. Investors at that point in time, though, for the most part, outsourced the investment into these asset managers, mutual funds, and what have you. And so, while we went from kind of one dominant form of capital market structure, we went into two, right? So, mutual funds plus, company sources of capital. And then we moved forward, and the next big thing that happened in my mind was, financial crisis thereabouts, where we started creating these vehicles called private equity, venture capital funds, and that sort of thing. And what we found was that we could actually aggregate large pools of capital. We could, bring investors and entrepreneurs like Pat's and Judy and Irfan to the table. They have to battle for that capital. It is not easy raising a fund, don't kid yourself. But they could actually move those capital sources down market into earlier stage companies. They could unlock value. They could build great companies. I've been around enough that great companies are fundamentally built. They don't just happen. And those capital sources are, for most entrepreneurs these days, I mean, the cost of capital is almost equivalent, whether it's a public source or of a private source. But still, we've aggregated capital into professionals. What's really, really curious about COVID and where we are today, and we're gonna, if you want to talk about crypto, we want to talk about kind of new vehicles that are sitting out in the marketplace. We have now democratized access to capital markets outside of professional managers, outside of outsourced vehicles, and people now have direct access to the marketplace. And they've shown up in this marketplace, whether it's through a Robinhood vehicle or otherwise, en masse. And they're able to now allocate capital based on what they value, and whether it is, whether it's on social purpose, whether it's on investment return, whether it's on, returns or things that catch their fancy, whether that be crypto or cannabis or what have you. And the movement of capital is so much more broad now. It's so much richer. And, even the capital markets, and I live this, I breathe this every single day. It's so new to have this surge of retail investors, this surge of a new capital source. We're not even structured yet to actually, help accommodate it in terms of what does that actually mean: proxy voting, boards, governance, social purpose, you name it. So I just want to maybe just sort of call that out. It's exciting. Judy, Pat, I mean, they stand on the cusp of this as well. This is really the opening up of the marketplace in a way we haven't seen before.
Great, thanks. Patrick, do you want to add anything on that?
Yeah, absolutely. I think what John's highlighting is it's just a democratization of the capital markets. And so I think, if you look at the public markets, I remember Warren Buffett being able to do a deal with whatever company with special warrants. It's stuff that, on the street, nobody else can get, right? And I think the venture market was very much the same way, which is, look, unless you're a qualified investor, unless you know how to source these deals, you're basically not seeing any of these deals. And I think ultimately what these funds do is they open up access to a wider group of people. So I think most recently what you're seeing in the private side is you're seeing funds, or you're seeing platforms like AngelList being able to put micro amounts of investments into early stage startups. I think from a regulation standpoint, we have to be very careful with this, which is it's very risky. And if you don't know what you're doing, you can lose your money very quickly, which it only takes a few of these incidents for people to lose a few $1 million for the regulator to want to step in and to protect people. So I think there's a balance to be had on this overall. But I think what we're doing as a fund, and I think what Judy's doing as a fund, and many other funds out there, is essentially trying to de-risk it all. Because number one, we're professional fund managers. Number two, there's a reason why we're doing 95 investments. And you know, if you look at the risk profiles, we can lose half our companies. So half our companies can go to zero, but we've modeled it out for really decent above market returns, because that's just the nature of venture, is that when you win, your one win can cover all your mistakes. And that's happened in cases of companies like Uber, where, you know, it's something like 25,000x on the original seed investment. Coinbase is something even north of that, right? So that's how venture funds are built. But you can't expect to win 100% of the time. This is not kind of safe bond yield investing. And so you have to model your portfolios differently. So I think, you know, in talking to investors, when you apply traditional investment rules to venture, it doesn't work, and vice versa applies as well.
Okay. Judy, I want to ask you, you know, you talked about democratizing investment. So in the private markets, you're going to have to do more of your own legwork unless you've got this someone helping you. You're investing through a fund, but even if you're investing through a fund, you're probably going to be subject to some minimum investments. Both of those, you know, sort of understanding the space and the dollar amounts could be barriers to participating. Do you have thoughts on, you know, is it possible really in the private space to democratize investing, and how do we get this more diverse investor base?
Yeah, indeed. I mean, the democratizing investing is very much what we're focused on, and I think there's two pieces of it. It's being able to make it accessible in terms of how you can get into a fund, and a pooled fund being really critical, as Pat highlights, because you want to have the portfolio. Because it is high risk investing, the ones that might win and those that may not do as well. I think the other critical part of this as well, and as a side, you know, in our first fund, we've made it possible for investors to get in, accredited investors to get in at $15,000. And it obviously has gone up from there. But the other piece that's super important, I would suggest, is the education aspect so that you're informed on the risks that you're taking. And I think we found as well that actually education and community are critical for women to take the lead. And so from the experience that we have in setting up the inaugural with the University of Calgary and Canadian Women's Foundation Financial Feminism Investing Lab, and again, huge shout out to Haskane here, Jim DeWalt and the whole crew there, that accessible education is important to have that, understand the fundamentals of how to look at a term sheet, get through the legal stuff, get through all the jargon, due diligence. What do you go through to learn by doing? And so as we look at that opportunity for women and non-binary individuals to have a cohort opportunity of building a community, building a network, and doing it with some academic rigor. So I'll just put that shout out there. And just to take a story, like we find as well, stories are really key to getting to know our founders. They're key to getting to know our investors and well attracting them. Alexandra Shrake, young founder of Energy Minute. I think those in the energy world know how important her work has been to condense into a very engaging graphics to understand the facts there. She got involved in a financial feminist investing lab and sees it now as a critical part of her portfolio. Again, a measured part of her portfolio. We don't want to have all our eggs in one basket given the risks, but a critical part. And so I just want to do a shout out. Our second cohort starts the end of this month, and there's still a couple spots left. It's an after hours 6-week program, and go to the website, our website, www.the51.com, partners page, if any listeners are interested. But the education piece is critical.
That 6-week program is going to give me, if I take it, I'm going to be able to know what I'm doing in the investing.
You know a lot already, but it'll move you forward. And if I can take another minute here, I want to really do a shout out, Denise, to your leadership and the ASC, because you're making it possible to further democratize by taking the leadership in Canada around expanding from accredited to eligible and self-certified investors. And we think that's so important because, and I think Irfan would love to get your comments here shortly from our earlier conversation, the middle class, the younger generation, they're going to be more challenged to build the wealth opportunities that we might have seen. And so they may not as easily get to the accredited investor eligibility, and we need them to learn by doing. And I find, particularly for women, this is critical, because when you build the financial and commercial acumen you get through being in the driver's seat of investing yourself versus passive, you become better leaders. You become better entrepreneurs. That classic point of you're getting P&L experience, board directors and more. So to me, it's a foundational building block to enable women in particular with the right skills as eligible and self-certified, in addition to accredited, to be able to invest.
Yeah, Judy, to respond to your question, I totally agree with you, and really need to underscore just how important that self-certification initiative that the ASC took on is. It really is foundational to our values, in my opinion, as a society. I remember the first time I did a private investment, and there's all the paper, right, to get your exemption and all that kind of stuff. And my wife looked at me, she's like, what is all that stuff? And I'm like, oh, honey, this is how the rich get richer. Because all of the, certifications were about, do you have X dollars? Do you make Y dollars? Think about how discriminatory that system is. That's a system that says if you're wealthy, you can get wealthier. If you're a man, you're more likely to get wealthy. To Don Farrell's comment earlier today, if women make 80% of men, they're less likely to hit the certification. And so it's like, it's biased against women. It's got that biased against people of color. It's biased against, socioeconomic class. This system that the ASC has said and put forward has said, if you are educated, if you can go and, approach and self-certify, that's much more egalitarian. And I'm very proud of that work. I think you guys really need to be commended for it.
I just want to throw another point on top of that, Irfan and Judy, which is it's just so important to understand what the history around this is and what the results have been. And so you have women that are 51% of the population, yet women's health traditionally has gotten around 10, maybe 15% of funding. And that's as a direct result of the money just being held in a group that basically said, hey, let's put all this money into researching men, and men aren't that different from women, and so that can just be a small piece of the budget, right? And so you can see how that goes off the rails. And so today, Judy's task of putting more women into those investor seats will just have naturally great consequences for society. We're doing quite a bit of this ourselves. We have a great women's health tech portfolio. We've got a great portfolio of minority founders. And I think this leads into the discussion of ESG, which is over the last, let's say 10 years or so, we've moved from shareholder rights, which goes exactly to what Irfan was saying, which is like, if you have money, you get a say. And that's shifted in recent years to stakeholder rights, which means that if you live in the community, if you're a customer, if you're tied in somehow, some way to that company, you should get a say, right? And this is so important. And this is not just activism. This is the right thing to do.
Well, maybe sort of building on that, I guess, but a bit of a different spin. This morning's panel was talking about ESG, environmental, social, and governance factors. And we've got some questions in the Q&A here on that. To what extent are you seeing those types of factors? You talked about stakeholders, Patrick, but social and governance issues, ESG issues coming up in the private space, in the venture capital space?
I think that you're seeing quite a bit of it, because I think most successful entrepreneurs, where they have money beyond what they can spend on their regular day-to-day needs, and this is a great indication. I think it's always happened, but it's always been kind of hard to show how you care about the community and how you care about society. So we're talking to investors every single day, not only individual investors, but corporate investors, basically coming to us and saying, what are you doing to create more diversity? What are you doing to make the world a better place? So they don't want a pure economic play. And just to give you an indication of that, in our investment agreement that we have, our shareholders agreement that we have with our investors, there's a whole list of things that we're not allowed to do. Right? For instance, we're not allowed to do anything that borders on immoral or illegal. And when you think about it, if you want to make the most money that you possibly can, maybe what I should do is just run a drug cartel, right? But clearly that's in violation. But then if you move it closer to a gray area, right? I think Bitcoin is interesting because of the latest debate around, well, what's environmental impact of mining Bitcoin, right? And I think these are serious issues that we have to deal with. Now, there's a variety of ways to deal with it. Is carbon sequestration enough, right? Is buying carbon credits enough? So these are issues that I think are worth talking about, because just looking at the Bitcoin price chart, which has just been on fire in the last year or so, people are saying that's not enough.
If I could hop in here, Denise, as well with a couple of thoughts. Pat, I think that part of your comments, I think inferred that there's a difference between social return and financial return. And I actually think in the fullness of time, we're going to see these two things are actually highly correlated, and for two or three reasons. The first is, like, I fundamentally believe when you have a diversity of perspective, you end up with better decisions, and we've seen that in multiple studies. And I think we need to, if you really want to get ahead as an investor, I think you need to push what do you mean by diversity. So 5 years ago, that meant that we had women in the boardroom. But why didn't we see further and say, well, now we should be thinking about Indigenous people and people of color? I actually think an area of diversity that we're not talking about that we really need to think about is actually on age as well, and socioeconomic diversity in your decision making in your investment committee. Because when you think about young people, they're going to come with maybe to Don Farrell's point again earlier today, super hyper intelligent, probably more intelligent than we were at that age, and probably seeing trends earlier because they're just exposed to different things than we are, but they're not coming with the wisdom of having 100 reps, right? And so when you look at our team at Relay, we have very young people in their early 20s and we have people in their 70s that are helping us make decisions, because we think it's the balance of both of those things. I also think it helps with deal sourcing, right? When you have diversity on your team, I just know that as somebody who's an Indian Muslim, if I meet an Indian Muslim, I just already have, for whatever reason, natural trust. It's true, when I think about who I want for my lawyer or my doctor, or frankly, my investor, because I just feel like maybe they understand me. And I think that if you have that, you're going to do better. And the last thing is, I just fundamentally think as power is shifting and the financial power is shifting and there's flows of capital that are shifting, to Judy's point, by 2030, 2/3 of capital controlled by women, this change, this generational shift of wealth. I think the value set of the people that are going to be making decisions on where they're going to invest is maybe different than it was where people were 20 years ago. And so when you think about these flows in terms of valuation, we're seeing big headwinds in oil and gas and big tailwinds in areas that are socially oriented. And I think as a venture investor, when I think out 10 years, I think that our multiples on things that are more socially oriented on exit are going to be stronger. And so I think that social return and financial return are actually, in the fullness of time, I think they're going to travel, together pretty highly correlated. And the last thing I'd say is, not only are people like us talking about this, a few weeks ago, the government of Canada issued an RFP for a $700 million social finance fund. And so, this is starting to be real. And I think we'll look back 5 years from now and we'll reflect on this conversation. I hope I'm right, but I think we're at this inflection point.
Okay. John, there's a question here I'm going to direct to you from the Q&A. And it says public markets are the ultimate form of democratization of capital. But in technology, those companies which go public effectively lose their scientific research and expenditure credits, which is a particular and significant bias in favor of government employee pension plans and private equity and venture capital. What can we do to put pressure on the capital markets to publicize and change this bias and to change the government business support to not disqualify public companies? Sorry, that's a lot.
A lot going on there. My general bias would be that any business that is built on the loving hand of the government is probably challenged. And that's just a general comment. If you're winning in the competition for capital, if you're winning on the ability to innovate, and if you're winning on the ability to kind of create value for your stakeholders, your shareholders, those incrementals, and don't get me wrong, I know it's important. I know every little leg actually fundamentally helps. But it's sitting in front of this team here that we've got on the panel and winning in front of them that actually fundamentally changes the value proposition. There's advantages to being public. There's disadvantages to being public. There's advantages to being private. There's disadvantages to being private. I always look at a company, and my first question is, when I'm thinking about the capital structure, I'm thinking about the financial source, is what is the corporate strategy? Where are you going? And then the next question is, what financing structure, helps enable that, and what's the best able to move you forward with that? What do you need to be successful in your corporate strategy? And then that I think answers your financing strategy, whether it's private, whether it's family office, whether it's going public, whether it's sovereign or international, and you should move forward from that. Any help you get from the government is always deeply appreciated, but it is not the arbitrator of a successful company.
Hey, John, just another thing to add to that. I think that the range of evaluation just varies wildly now. In that, I think the markets have gone, the public markets have gone downstream. So you can be a public company with a few $1 million market cap, and you could be SpaceX, remain private at $100 billion US. And so the range of valuation, both the private and public markets, is just wild. And so it's not like it was so differentiated, a bunch of years ago. So I think that's an important thing to mention, is that I think you have to pick the right financing vehicle for your company. And there's a reason why Elon wants to keep SpaceX public, and there's a reason why, if you're hitting a $10-20 million valuation, maybe you want to go public, but maybe you don't.
Okay. I'm going to take just sort of staying in the public vein. There's a question here about retail investing, and interested in the panel's thoughts on the surge of the public using forums like Reddit to band together and influence the public equity markets, meme stocks, GameStop, BlackBerry, and such. Any thoughts on sort of that dynamic that we're seeing?
I mean, I think it's like just modern day boiler room, right? Like, so we shouldn't be surprised. Like, people are going to use technology to, update their ability to take advantage of folks. It was interesting to watch. I think that hopefully the public took lessons out of it. But we saw another fraud this morning, right, with Josh Carty out of St. Catharines. I mean, this is one of the things that the regulator has to, I think through. I don't know if my fellow panelists have a better answer than that. I mean, I think that, at least for me, when you see it happening, you're like, that's just not logical. Hopefully people don't get burned.
The thing that I would add to that is to look beyond the headlines and look a level deeper and seeing what's being enabled, right? So, when you think about the process of buying stocks before online brokerage, and now with Robinhood, it makes it even easier. And it's going to get even easier than that. And we're seeing some platforms out there allowing you to fractionalize the way that you buy stocks. So now if there's $1,000 stock and I only have $50, I can buy a fractional, I can buy 1/20th of that stock. So it's just super important to understand the capital inflows when you start allowing this kind of technology to happen, or when this technology comes into place. It just starts enabling a new investor class. I think it's also super important to understand that with this technology, now all of a sudden there are no such things as kingmakers, right? So now that you can log on and you can buy a cryptocurrency, it doesn't matter what Jamie Dimon thinks about Bitcoin, right? Like, yes, he may have billions of dollars to his name, but his opinion is one of 7 billion people, right? It's one opinion. And so, you know, clearly the world has spoken. You know, the Germans have basically authorized their pension funds to invest in Bitcoin. And so you're going to continue to see cash inflows. And this Bitcoin, I think, is the perfect example of the people speaking for wanting to where they want to store their value, but also the technology, incredible amounts of technology enabling this movement. And just to give you an example, the technology is being disrupted live as we speak. So Coinbase, which just recently went public, has just over 1,000 employees. You have these decentralized exchanges now doing more volume than Coinbase, right? More daily volume than Coinbase, with 1/100th of the staff. This is incredible. So our disruptive technologies are currently being disrupted. This is an incredible time to be living in.
Definitely. Anyone else have any thoughts on sort of this decentralized finance, or, you know, what it means to sort of the future of the capital markets, and maybe John, like the role of the dealer and things like that?
You know, again, in the spirit of an efficient market hypothesis, why it's coming forward as it is, pushing on, you know, parts of the market. You know, Patrick was talking about the kingmakers, a concentration of decision making, a concentration of capability that wasn't working fundamentally for the efficiency and the free flow of capital. And we can talk about high frequency trading, we can talk about dark pools, we can talk about algo trading. There's a lot of things that was happening underneath the market that wasn't effectively allocating capital. And you can challenge if Mime Stops and the AMC and GameStop is an efficient allocation of capital. But what it is it's a push on the system. It's a call out that the system itself needs to adapt to what people want, what people need. And people have the power, they can congregate. I comment on this. I mean, this is a generation that grew up on World of Warcraft. They're very well organized. They understand leadership. They understand the power of defeating the game. They really understand the rules of the game. And they took on the game. And that's really what happened there. And it's interesting. It's not sustainable. Regulators are alarmed and worried, and they absolutely should be. But there's an element here that is also, you know, driving that efficiency of capital, that efficiency of kind of moving forward. Notwithstanding the fact that I've got a great business and, you know, as a broker dealer, and I love my institutional investors, and I love our mutual fund business, and I love all the things that we do as an industry. I also know we can do better, and I also know that this industry will evolve. And in general, if it moves forward with the right regulations, the right partnerships, it gets better and better with time. And we can open up access not only to what Judy's doing in terms of bringing in a whole new investor class to the table. We can also introduce new investable assets, which is also what sits there, you know, in the middle of this DeFi. Whether it's real estate, which is primarily a private investment opportunity until you get to these large public vehicles, or whether it's other value sources, and we're seeing all kinds of experiments across the world right now for those.
Just picking up on the theme of decentralized decision making and the concentration of power. It's bring in a company. It was founded right here in Calgary by my friend Brian de Lawtonville of Benevity. They took the billions of dollars that was being made by these kind of corporate sponsorship offices and basically decentralized it to all their employees. And so I'll give you an example here. If you're, previously before Benevity, if you're Google, you had a few people just making decisions on where the millions of dollars that they donated to the community went. And now, if you're an employee of Benevity, you actually get a spending budget, and you're not only helping to allocate where Google does its corporate donations, but you get to do employee matching as well. So if you donate $3,000, Google will match on top of that. And so we're just seeing decision making across the board being decentralized through this technological shift.
That's great. I'm going to take us back to some of our earlier discussion because I see that I missed a couple of questions here. Judy, there's one for you, and it's a bit long. It says there was an article by Alexandra Sagan in The Logic that noted that between 2016 and 2020, there were only 2 of 43 companies that completed IPOs on the TSX that were founded by women. And that this seems quite a bit lower than what you're seeing in the startup and venture capital space based on, some of the statistics you've outlined. In your belief, is this an issue of public markets simply taking longer to show some of the progress being made, or is it a result of venture capital having an inherently more progressive approach to finding untapped value and potential when compared to traditional investment banking?
That is a very, very good question. And I think, yes, I think we see really strong stats, especially in this province, in terms of women-led founders. If we look at other studies, I think as you go up and you're taking that inflection point from startup to really, really, really grow, it becomes more challenging to raise financing. And I think what it comes down to is the founding team and how we enable particularly women-led companies to believe that they can dream that big. And I want to, if I think about, just as an example, Clearco, co-founder there, Michelle Romanow, who hails, of course, from this neck of the woods. I remember meeting her when she had just come through to the Shad Valley program, and was exposed as a high school student to entrepreneurship and innovation. And then, the difference that made for her to think big. And I think, and believing, and then being confident to be a serial entrepreneur. So I think, one of the things that's so important is to have role models, to actually have a belief from a young age that you can actually do that and start taking the risks to get there. Because there's, for anybody that finally gets to an IPO stage, it's quite a journey. And you've got to have a lot of skill sets to drive that, and a belief you can get there, a belief to think big.
Yeah, Judy, if I could just add to that, currently the study that we have says the national average of early stage companies founded by about 13% of them have at least one female founder. Currently, Panache is sitting at 24%. And, it kind of goes to show you how tough this game is in getting there. It's going to take time to get there. And yeah, I think that as this winds through the market, let's face it, it's tough for anybody to raise funding. Question is it tougher for women to raise funding? And I believe it is. And I believe organizations like yours and ours, we're making steps to fix that. But it's not fixed overnight, but we have to put concerted effort towards this. This is, I think it's a huge concern. And, highlighting again what Irfan said, this is not only a problem for women, but it's a problem across the board, across all demographics. So for instance, why are we ignoring, let's just be pure capitalists for a minute here. why are we ignoring underserved markets? Why are we ignoring minorities? So, I think a great story of that is Magic Johnson one day went to Starbucks and said, "Why aren't you putting Starbucks in East LA?" Right? Our people spend money on coffee. They'll buy your $10 coffees, right? And Starbucks basically said no. He opened up his own coffee chain, and he sold years later, after it was cranking out all kinds of cash. Starbucks bought it, right, for hundreds of millions of dollars. And I think that's just an example of just basically concentrated decision making. And I think the same thing right now. You're seeing stats on women, but I think if you look at the stats on minority founders, you're going to find very much the same thing. And I think it all needs to be fixed through this early stage investment.
I think it needs to be fixed by changing who's in power, right? So I talked about this earlier, in that you have natural trust, and so if it's old white guys that are the managing partners of venture capital firms, like there's just going to be, it's not conscious, right? Like it's subconscious, and you can't sort of blame people for where they're naturally more comfortable. And so the challenge for us is that venture capital, like entrepreneurship, is an apprenticeship business. So we have to work really hard to get different people into these seats of power if we want to have a different outcome. And the only last thing that I'd say is, whoever asked that question, thank you for the shout out to the logic. I chaired the board, so I appreciate you reading it.
And if I could add just for a moment, Denise, this point around natural trust, I think, is absolutely critical. And, we have a number of founders that will come to us. They'll say, "You're the only group we've ever talked to that are women-led." And it attracts deal flow, but I think it also enables this ability for us to have a very candid conversation early on that they feel safe in terms of what is it going to take to grow your company. And I think, just an example of that, the work that we've done, and Shelley Kuiper's on the board with Virtual Gurus, Bobby Brissett, an oil and gas worker who saw that she was going to be out of a job, formed her own freelance platform, almost kind of like Toby's story from Shopify, built something first for herself and then has grown that to tap into underrepresented, untapped virtual workers, whether they're Indigenous or stay at home or other rural, and has a business. It's one of our best performing companies. So I think back to the point earlier, you can have economic potential and social together, and all you got to do is have that nice collision of the intersection, where the founders come to you, you work with them, you grow it. And I think that's where we're going to see our next generation of companies that make it public.
Yeah, and Judy, you mentioned Michelle Romano going through SHAD. I currently sit on the board of SHAD, and I want to just give a shout out to what an amazing organization this is and the mission behind it. And for those of you that don't know what it is, it's essentially encouraging young people to go early. We're talking high school age, to basically lay them down with a foundation and motivation, putting them, in a cohort of other people that are ambitious about math, arts, science, and engineering. So really important. It's a national program. There's thousands of kids in it every single year, and we need to spark not only the right demographic in this, but we need to make sure that we're pointing our young people in the right direction. Which is, I'm a sociology grad, and I'm not sure that having a sociology degree gets you very far these days. Is that, if very clearly what we're seeing is that this world is becoming quickly one of technology, we've got to educate our children in technology, but also in arts and math and everything else involved. And that's what SHAD does. And I think it's important then, when we have that the next discussion, which is, what kind of things are we going to instill? What ideas are we instilling in our children's minds? Are we going to say, Instagram is important and girls should only do X and guys should do X? And SHAD just basically blows all those assumptions away and says that, you know what? If you're female, you can do anything. And oh, by the way, here's a professor from Waterloo. She just won the International Nobel Peace Prize for physics last year, and she's on our speaking agenda. You should have a direct line to her, right? And so that's a kind of thing that's going to bring this kind of long, sustainable societal change.
Yeah, I would second Chad, Pat, and just the quality of that program. And I know this empirically because 25 years ago, when I was in high school, I applied and I wasn't good enough to get in. So they have a very high bar, apparently.
You're not feeling very much love today, are you?
No, not at all. Especially not from you.
I'll make it up to you.
All right. Okay, let me see here. We got another question, and maybe Irfan, I might pick on you just to start with. It says, does the panel think that the cost of capital prevents retail investors from accessing the venture space through non-fund registrants, through dealers, that could theoretically assist with some of the de-risking elements of entering the space as an investor, but often come with high commission charges to the startup or scaling business? Did you follow that?
I understand the question. It's, is the fact that you can't get direct access and there's an intermediary create so much financial punishment that it's not worthwhile making the investment? I think the different challenge might be, and this is a might, and I know Judy and Pat are doing a lot more in terms of really opening up their funds to this investment. It's one of the things we struggle with, right? So like Judy's got at the 51, it's $15,000. At Relay Ventures, it's typically 5 million US or higher. Like that's a pretty big barrier, right? How do we think about democratizing that without creating costs to the fund in terms of administration, right? Like every new limited partner we bring in takes administration and time, and that comes with cost. And so, at a certain level, it's really not worth doing. I do think that as we see decentralized finance continue, there are products that actually might track funds. So you could probably get like an ETF that tracks like the Relay Fund or something like that. I can see that happening. And part of why I can see that happening is while there is this intermediary cost, the returns are pretty exceptional in this asset class right now, right? We're seeing our funds doing 30% or higher net IRRs. There's a lot of room there for an intermediary still for you to still beat the market and get the diversification potential. But I think, Judy and Pat are probably spending more time thinking about this than we have. I do think it's a challenge, and, it's one that I'm sure somebody smart, just like they did with, other areas of and Robinhood in terms of opening up investing. I think that there's something here where this product could emerge.
Yeah, I think the other thing is to think about this from a more holistic standpoint, which is there are people, these intermediaries, and I see myself as an intermediary on this. We charge management fees for what we do, right? And the key is that we have to produce more, and hopefully heck of a lot more than what you could do on your own, and then there's value, right? But there's also fees going the other way, which is there are businesses and consultants that charge the companies a fee for raising money. So I think all this just speaks to friction in the market, and sometimes it's led by administrative fees. It just takes a lot of time to deal with these files one by one, which is why Irfan has set a higher limit. But there's also information, friction of information, which is how believable is the information that you get is on a venture. And then if you had a pipeline of millions of companies, which one would you invest in? And I think that's a situation where we're in today on the public markets, where you only look at maybe a basket of 10, 20, 30 stocks. It's not possible to look at every public company out there. And it's virtually impossible, in very much the same way, and even to a greater extent, looking at private companies, right? There's just too much to look at. So I think there's a friction around massive amounts of information, a friction around administration. Can technology solve this? I think that it's going to be an interesting problem going ahead, right? And I think, what's interesting, I think today for both companies and for investors, the competition is actually not for capital anymore, because there's plenty of capital out there. The competition is for attention, right? So think about yourself as a consumer. 30 years ago, when you walked into a grocery store, there were about 15,000 products on shelves. Today, that's into the 50,000 product area. So just think about it. It's not like we have 3 or 4 times more different kinds of food. We just have three or 4 or 5 or sometimes 10 different kinds of brands around there. And so think about how clouded consumer choice is for consumer products. And that's happened in every other sector, including the investment industry.
If I could, Denise, just to build on the business model question of how do you make democratization viable? Because I think it's an excellent question. And I mean, I'll start first of all from just CDL and how critical that's been, again, as we talked earlier in our ecosystem, and that's taken the significant investment of university and others, but of course the founding partners that are there, that are building it up, the corporate partners, which is actually synergistic because you've got the investors, plus you've got the market pull that might buy the technology from these companies. And I think perhaps we need to look at emerging funds and the like so that we don't get caught in this catch-22 of how do you ever get started, because are they economically viable based on management fees only, to think about what you're doing in growing the ecosystem. And so, ourselves, we have our fund, we also have our not-for-profit that's really focused on the education side of it. And hence investment in that side of it is critical. Plus, of course, we also have investor memberships where we offer education alike. So it's not just a one management fee type of option that makes this viable. You need a not-for-profit to recognize you're building the ecosystem at the education and how you're educating your investors as well. So it's that whole system approach, and how do we finance that so that we get the change we're looking for. Management fees alone doesn't do it.
John, did you want to add something?
Yeah, maybe I appreciate the question, and we struggle with this also as an intermediary in terms of what is the proper level of due diligence. How do you, our firm stands at the gateway to the capital markets, and what do you do at the gate? Where do you add value, and how do you make it efficient? And I know the regulators very much look at this as well. And there's a spectrum of let's call it a burden onto the company in terms of disclosure requirements and capability and capacity. I mean the need for chief financial officer just as a minimum requirement to be a publicly listed company starts coming into play. And I would be of the view that as we push down and we lower that burden of being public, we get better outcomes. But to Patrick's point earlier, it doesn't come without risk, and people need to fundamentally understand that. And by the investment bankers, I mean, we build the financial models, we build the decks, we build the marketing material, we ensure that the issuer is satisfying the required regulations in order to kind of get to that status from a investor protection perspective and just a primary due diligence. But it's also, we're facilitating industry formation, we're facilitating kind of good outcomes. Going back to cannabis, I'm a little fascinated by it, but what we called out as a society when we legalized it, we said, listen, it is not good for us as a society to enrich the criminal elements. We have an installed user base, and we haven't shed the light of science onto this, into this plant, nor have we, professionalized the consumption and the distribution of it. And so we took an industry from the shadow economy and we put it into the public markets, and it was the highest light of scrutiny, governance, and high risk appetite capital, like high risk appetite capital. And a wave of it kind of moved forward, and now wave after wave has kind of moved, and we're building an industry, and we're taking it out of a place which really was inhospitable, was not good for anybody in society. There's a tax base, there's science, there's R&D. And as an industry, in terms of being the intermediaries on that, that was challenging for us. I mean, there was a ton of companies that had a long history, and that wasn't a good thing because they were, by definition, operating in not under the mantle of legality. But where we are today, the governance, the social improvements, the business model improvements, the allocation of capital, the business model developments is so much further on than where we were. And so, yes, there is a cost burden in terms of moving it forward. But if we didn't have some of the exchanges that we had in Canada, the legalization plus the industry formation wouldn't have occurred. And if you have too high a bar, you don't get the capital coming in, nor do you get the companies coming forward. Private equity couldn't play. The endowments, the fund, the capital providers that fund private equity, for the most part, had prohibitions, to Pat's earlier point, against investing in types of these industries. And so there was a structural prohibition as well. And so the capital markets in this context and the intermediaries added, I think, significant value to wealth creation, but also business creation.
Great, thanks. It looks like we have a couple more questions that take us back to sort of that ESG discussion. And there's one here for Patrick. And whether you have any concerns with too much focus on one element of ESG. You mentioned crypto mining. Is there any risk that there's too much focus, would create negative outcomes?
Oh yeah, for sure. I think anything taken to an extreme is bad, right? I think that ultimately what I'm seeing with ESG is basically saying don't be singularly focused on profits, right? Make sure you understand the people, make sure you understand the world that you live in. Make sure you understand what it takes to run a good company. I think that we've always had some form of ESG, but it may have been a little more focused on governance rather than on environmental or social. And I think we've seen E and S really come into play in the last few years because, listen, it would be offensive and basically just downright stupid to say that the environment doesn't matter and that the world as far as the social aspects doesn't matter. Question is how do we find the right balance in all of this? Because I think in all of this we need sustainability, right? And I think that ultimately we need to find a way to make the environmental, to address all our environmental concerns, yet still do that in an environment where everyone has jobs, right? So I think that any argument taken to extreme is a bad thing. And so when we have people out there making, I think, very illogical arguments about saying this needs to be shut down or this needs to stop, I'm not sure that takes our debate anywhere. But these things are nuanced, and whenever you bring these polarizing arguments to the table, it just doesn't work.
Denise, if I could just build on that, given a deep background in sustainability and energy, I think in the first panel today, it's an incredibly exciting time. And I think, to coin a term, economic ESG, to build on Pat's point, which I think Macmillan has framed very nicely. And what I think is really fascinating about the time that we're in right now is with ESG being driven from the financial communities, we are actually have a market pull now that is saying, for the companies to meet towards their net zero objectives, they need to have a plan. They need to have investable companies. So the pull for clean tech and companies in that regard, as well as when you look at the social side of it and the objectives that are being set, whether it's driven, from the markets or the 50-30 challenge set by the government, that's creating a pull for diverse founders as well and opportunities. So I think, for been in the realm of innovations for some time, including government policy on this, it is an incredibly exciting time where for those in the technology realm, whether it's clean tech, your diverse founders, fintech, whatever, there is a pull to accelerate your business opportunity.
John, did you want to add anything? I think there was a question here for you. No, I'm missing it. What's your view on how energy and its role to net zero, and how do we get financing directed there in the public space?
Yeah, that's a great question. And I actually think that panel before us articulated it well. One of the things that I guess is on the table, and Judy talked about it to some extent, is disclosures and the ability to disclose. We know, fundamentally, whether it's the bank, like I run a $22 billion balance sheet, and I know, and I got very tight standards in terms of the amount of capital I can lose. I know that the most common source of capital loss is issues that come out of governance, comes out of sometimes it's market conditions, but usually it's something that sits on that ESG dimension, and so that's just a fact of the bank and moving forward. Every company has different capabilities to kind of perform on these metrics. We are calling out, as a financial community, that these metrics are material. And that's a technical term in the markets. If it's a material risk, it requires disclosure. And we know that companies that perform better on these metrics, on these material risks, are more long-term sustainable, create more value, and fundamentally are better investment opportunities, right across all the financial dimensions. And so we are working through just how to articulate, how do we put the right terms on it, whether it's, how do we label, the right things and measure the right things. And the only thing I would maybe just add to that comment, there's a lot of enthusiasm around this topic, and there's a lot of enthusiasm around it. And as investors and capital allocators, we've got a lot of intuition. It's very nascent. We're in the first inning of understanding exactly what the correlation is, what the covariance is, what the portfolio contribution, the risk portfolio contribution is from some of these different dimensions. Intuitively, instinctively, there's a lot of knowledge out there, but we haven't codified it. We haven't put these metrics in play. And so we're going to come up with our first round of metrics and mandatory disclosures, or I think the CSA put a paper out on that a couple of weeks ago. We're not going to get it perfect the first time. There's going to be an outcry, and there's going to be all kinds of comments. That's good. That's the public discourse that's happening. And then we're going to refine, and we're going to put these things into the algos, and we're going to run these metrics back into what drives, great outcomes for these companies. And we're going to get better and better at this. And then it's going to be iterative. I'm excited about that. We're standing right on the cusp of really a new opportunity in terms of allocating capital more efficiently and effectively. But I'm also humbled by the fact that it's going to be a lot of skin knees.
I think, John, just to build on that point, there's just so many measures that I think we're only starting to understand. So, for instance, if you look at Tesla and you say, well, EVs are great. Well, that's just basically zero carbon emission at tailpipe. But the resources that it takes to build a Tesla, if we went out, I read somewhere that it's actually way more efficient for us to actually keep our cars on the road for another 7 years versus going out and buying a Tesla and sending our current gas cars to the landfill, right? Because when you think about all the resources that it takes to do some fairly dangerous chemical mining, lithium, for instance, to build battery packs and solar panels, there's impact to that. And so how do you measure that, right? Because I think as consumers, we see one measure, but we don't see the entire picture. And we can't even begin to measure that. So I think this illustrates how important it is to have data, but it also illustrates how complicated this question is.
I think we're going to have to wrap it up there. We're at our time. I don't know, does anybody have like any 30-second last nugget you want to leave, really 30 seconds last nugget you want to leave the audience with?
I would love to thank the pioneers in this province. We are a pioneering province, the founders that are making things happen, the investors that are taking calculated risks to diversify this province, and ASC, I mean, yourselves for having that enabling role and putting the appropriate guardrails in place. So the ecosystem has advanced so much in the last couple of years. It's so exciting.
Great. All right.
Go ahead. Comment for me, Denise. I think that to me, this illustrates like how intimidating investment can be sometimes. But I think we're hopefully here we made it a little bit friendlier, is that you can find us all on LinkedIn, reach out, get a hold of us if you want to find out more about investing. It's part of what we're doing in the ecosystem is trying to get everyone more involved. We want to be a part of this democratization process because I think it helps the entire economy. It helps Alberta in general. So it's more than just about the money. It's about getting people involved.
Okay, thank you. All right, thank you, each of you, Judy, Irfan, John, Patrick. That was great. Very valuable conversation. Please, I'm sure everyone would join me in giving you a big round of applause if we could do this live. So thank you very much to all the panelists. Thanks to the audience for joining us. Stay safe, stay healthy. We're going to take a short break. We'll be back at 11:05 with our chair and CEO, Stan Magidson. He'll be hosting a fireside chat with Darcy Halston of Canoe Financial and Craig Sinek of Moore on building the financial services and fund sector in Alberta. So have a quick health break and we'll see you back in 5 minutes. Thanks.